Hi, Bill Ethman here for MoneyEvolution.com. In today's video, I'm going to be talking about fixed annuities. So this is part of an entire series that we're doing all about annuities. So if you like, check out the description below this video. We have links to all the other videos in the series, including some of the other types of annuities where we're going to be taking a deeper dive into those. So fixed annuities are really pretty simple and straightforward, at least compared to some of the other annuities out there. But I hope in this video we're going to just kind of go over some of the highlights of them, talk about some things to watch out for and some things that you should know before getting into one of these fixed annuities. So first of all, the best way to think about a fixed annuity, I guess to just put a frame of reference there, is to think of them kind of like a CD. So generally fixed annuities, and there's two basic types. There's the traditional type of fixed annuity, and there is also something called a MYGA, which stands for multi-year guaranteed annuity. And so typically with a fixed annuity, they're going to agree to pay you a set amount of interest. With a traditional annuity, they're going to give you a rate, and that rate could change over time. Maybe it's going to be locked in for a year. Something to look out for is sometimes these will even kind of pay some teaser rates where it might seem like, oh wow, that's a really great rate compared to some of the other options that are out there. But that rate may only be locked in for a short period of time, and it might even be a lower period of time than the surrender schedule that there is on the annuity. So you might have a rate that's locked in for a year or two, but you might be locked into that annuity for 5 or even 7 years or longer. So, and then maybe subject to whatever those rates are going to be. With a multi-year guarantee annuity, that's going to be more like think of it like a longer term CD, where you can maybe lock in for maybe a 2-year, 3-year, maybe even 5 or 7 years. You know, and generally speaking, if the yield curve is positive, you're generally going to get a little bit more interest the longer you go out on that time horizon. But typically, if you bought like a 5-year as an example, that rate is going to be locked in for that entire period of time. But again, something to keep in mind is there typically would be a surrender schedule on that. Typically, the surrender schedule is going to match whatever term of that MYGA that you're going into. So if it's a 3-year, it probably has a 3-year surrender schedule. A 5-year, you're going to probably see a 5-year surrender schedule in there as well. And something else to keep in mind, though, is you do lose a little bit of flexibility once that money goes in. So of course, if you have a 5-year MYGA and you need to take your money out sometime during that first 5 years, you could get hit with a penalty. So that's going to be something that's going to be assessed by the annuity company itself. But with these fixed annuities, you also could get hit with something called a market value adjustment. And so basically what that is, just like most other fixed income instruments, the value of those instruments goes up and down depending on where interest rates are. So if you bought a 5-year MYGA and it was paying 3% today, and interest rates sometime during that went up to 4%, and you needed to take your money out early because rates are now higher than they were when you put that money in, you're probably going to have a negative market value adjustment. And that's going to mean that not only could you get hit with that surrender penalty, but you could also lose a little bit of principal as well. It can work the opposite way. So if interest rates went down, and if rates went from 3% down to 2%, you could get a positive market value adjustment that could offset maybe some of that penalty. But again, you know, that's something to definitely look out for there. A couple of other things. One is the size of the deposit that you're going to give. And so generally speaking, a lot of these will have a different rate that will be slightly higher if you're putting more than $100,000 in, and maybe a little bit lower rate if it's less than $100,000. So that's another thing to keep in mind. As with a lot of annuities, there generally are some free withdrawals amounts as well too. So basically that could be anywhere from 5% on the low end to maybe 15%. And again, these are the kind of questions that you want to ask and some of the terms that you want to know before getting into. So let's say if you had an annuity that had a 10% free withdrawal and you had $100,000 in there, what that means is you could take $10,000 out and you're not going to get hit with any penalties or market value adjustments. You can just take that $10,000 and do whatever you want to do with that. Another feature, one last feature I guess, with some of these is that they do have a feature where you can take your original principal out without any penalties at all. That's something that not all of these have, but some of them do. And you won't get any interest, but you also won't get any penalties as well. So that's one last thing to maybe check out there. So generally, again, these are going to be the most simple. Think of them as maybe an alternative to CDs or to bonds or some other instrument there where you can lock in a rate that might be a little bit better than some other options out there. Keep in mind that these are not FDIC insured, and that's going to be very, very important to know. So again, like with all of these annuities, you're going to want to pay really close attention to the credit ratings of the issuing insurance companies. A quality or better, in our opinion. AA is certainly very, very advantageous to go to that, because you want to make sure that these companies are solid and that they're hopefully going to be able to meet their obligations and pay you the interest and your original principal back and all of that. So with that, I hope you got a little bit better understanding of how these fixed annuities work. So in the next video, we're going to get into fixed indexed annuities, which is going to be a subset of fixed annuities, and it's kind of its own category there. So it's one of the four broad types of annuities that we're going to be talking about throughout this video series. So again, we'll probably have a link below to that video, and I hope you like what we're doing here. Hopefully this is informational and giving you some good questions that you need to ask before buying one of these annuities and determining whether or not an annuity might be right for you. So hit that like or subscribe button, and I'll see you back in my next video. Thanks.